Hello, folks. Jim Hiles here. Hope you're well. Today is Sunday, the 21st of February. I'm a little late on this weekly call. Oh, by the way, for those of you who gave me a hard time last week about my little phone action, I'm going to do my best to stay on 5 minutes. I know it's a little bit long, so let me see if we can do something with this. Okie doke. So here we go. We're going to go jump right into it. You have to look at what the comedians are doing with the election, but I watched Stephen Colbert the other night and I happened to laugh because if this isn't like Hunger Games in this election, I'm not sure what is. It's giving us about the same amount of comedy and brevity to politics as the movies. But if you get a chance to watch Stephen Colbert do this Hunger Game thing, it's pretty funny. So take a listen to it. I think we're down to, I don't know, 7 or 8 Republicans, a couple of Democrats, and a partridge in a pear tree. So we'll see what happens next. Let me move my camera here a little bit. So portfolio update. First of all, we got a little reprieve this week, and that was great to have one. It is definitely a slowdown. It may be a stop in terms of the selling stampede we've had. We had a nice little 3-day rally in equities, and with that, we saw some stability come back into the market, and we put some of the cash we've been holding on to into defensive equities by investing into a U.S. conservative dividend equity ETF. We're going to talk a little bit about ETFs as well because we need to learn a little bit more about them. Still, equities are battered. We're looking to buy in at lower prices, but we're not jumping back in just because we had 3 days in an up market. As a matter of fact, this up market is not solid yet. We may have another leg down as well. We're just going to stay vigilant and watching what's going on and let the evidence help us out until an uptrend is reestablished. We do have things sitting on the sidelines: technology, healthcare, consumer discretionary, staple stocks, and yes, oil stocks. So based on what I heard this past week when I was out seeing clients, people are asking me, what about oil stocks? So I asked our analysts over at Raymond James, and you can see this is the picture of crude oil prices. It's hard to believe that they were over $100 a barrel less than 18 months ago, and we've gone down 50% in a year. But we're right around this 30, depending on the day, 32, 33, $30 a barrel. The analysts are basically saying, hey, looks pretty bleak out there. We have way too much of this stuff, but we are going to be looking to buy companies here with strong balance sheets, premium acreage, healthy debt adjusted production growth, prudent management teams, and we're looking to do it from generally the Permian performers. Let me give you an idea of who that might be that's standing out here waiting in the wings. So we've got, with this outlook potential, by the way, they're saying that the end of the year, the price of oil is scheduled to be above 50 into next year, getting back up to 60 or 70. We'll see what happens. Here are the names we're targeting for those of you who are following stocks that we'd like to look to add to the portfolios. Probably one of the biggest things that happened this past week when it relates to oil was Buffett's recent purchase in the energy space of Kinder Morgan. Generally, that's a good bet to follow Buffett, so we're going to keep our eye on that one and watch him closely. Quickly, I want to cover ETFs just as a once-over. ETFs, we think, are one of the most efficient ways to invest into the marketplace. They are essentially funds that track indexes like the S&P or the Dow Jones, and you buy it like a stock, and it tracks the yield and the return of the index or the underlying stocks or bonds or whatever they happen to hold inside this fund. The main difference between ETFs and index funds is they don't try to outperform the index. They just try to be the index. So they've been around for a while now, and there's a very nice growth curve on the ETFs. And there are a lot of benefits associated with this. ETFs combine a diversified portfolio with the simplicity of trading as a single stock. And you can buy them during the day, you can short them, you can buy margin, or simply hold them for the long term. ETFs are usually more of a passive management, meaning they buy the securities and make only minor periodic adjustments, as opposed to an actively managed fund, much more like a mutual fund where the manager is continually trading assets to try to outperform the market. ETFs tend to hold on to a discrete number of stocks, as opposed to a mutual fund, which is subject to continual change based on the management's decision to buy, sell, trade securities. At the end of the year, you essentially end up with the performance of what the manager has done. We do know in the last 5 years, indexes have outperformed managed money, and that allows more credibility to go into ETFs by taking out this managerial risk. A few other benefits to ETFs. You're basically looking at replicating a basket of securities, which often are going to mirror the index. So it's less to do. Therefore, there's lower administrative costs. This basically comes back to benefit us as investors. And when you look at the differences between this, I just want to make sure that everyone understands this is a big point. ETFs are very inexpensive in relationship to mutual funds. Some mutual funds are almost 1% of internal cost per year. On average, ETFs are closer to 20 basis points or 0.2%. So we don't have high sales costs and the costs and taxes that generally might weigh down your return. Speaking of taxes, we are trading a large number of securities as one, and therefore, when you have an opportunity to do that, you don't have a lot of trades with using ETFs and a lot of tax issues. When you look at ETFs tax efficiencies from a administrative costs, lower capital gains, basically allows us to keep more money in your pocket, and if you can do that over the long pull, compounding will work for you. So we think ETFs are a solid part of everybody's portfolio. It is the quickest way and most liquid way in and out of a market position, particularly if you're establishing a great number of stocks or you want the diversification we all tend to look for. Well, that's about my 5 minutes. So I'm going to wrap it up here. If you have any questions, give me a call, and that'll conclude our Weekly 5 with Jim. We'll talk to you soon. Thanks.